Welcome to the Fast Money Halftime Report. We're getting to the heart of the action as it's happening here today. The stock market trying valiantly to snap that four-day losing streak. Financials are leading the charge by themselves. How are the traders positioning themselves ahead of tomorrow's huge jobs report? Let's get the word on the street. The Fast Money crew today, the monster in the blue corner, John Najarian, of course, Jim Iorio of TJM, Greg Tricoli of Opalesk, and Eugene Profit of Profit Investment Management. Monster, with the big intro, do you like this market? Do you believe in this? Are we going to snap the four-day?
Well, Matt, and thank you for that. I do think that we're going to see a little pause going into tomorrow's jobs numbers, though. But so far today, so good. The better than expected chain store sales, the best numbers we've seen really in over a year, are, I think, providing a boost. And then, of course, the jobless dropping a little is a little bit of a hope that people are giving for tomorrow. But let's not kid ourselves. The first hour and a half is all we've got tomorrow. After that, the volume's going to be gone as people head out for Labor Day.
Yeah, it is a long day weekend, Jim. And, of course, you know, we've had a couple of indications going into tomorrow's number that this is probably not going to surprise positive.
Well, it's got, after this week, we've had those two ISM numbers that definitely surprised positive, so our appetite for being surprised the upside is there. If it doesn't, we'll probably see the continuation of the correction. I still think in the bigger framework of a bull market, we still are in the midst of a correction that, to me, has got to go down to 975 or 950 at the furthest before we've kind of satisfied the correction gods, trimmed the hedges a little bit, and it's time to get back in.
Greg, this is a financials market. If the financial sector is the only sector that's up or down more than 1% today, if you back up financials, we're actually down on the session. I mean, is this telling you something? Do you get worried about this?
Yeah, there's a lot of good news out there, and I just think the financials got way ahead of themselves. If you go on a stock-by-stock basis, there's been an awful lot of profit made here in the last 4 or 5 months. You know, we're going to look at the chart in a little bit, but I agree with Jim. I think we need to retrace back towards the 950 area.
Well, and I would just say, Eugene, that today's winner is the 5-day loser. I mean, the financials are looking at their worst week, if you will, since May.
Right. And they should be. I mean, they've had a really big run. The economic data did not support that type of run. But that being said, the retail numbers were very good today, and I think that if it wasn't September, we might be higher.
All right, let's go to the chart of the day right now. We always love this. Greg is watching the S&P right now with a special 21-day sizzler, if you will, right in the middle of it there today. And Greg, if you'll walk us through here and tell me what your reading is on this and if it's movable, actionable.
Yeah, Matt, that's my key indicators, the 21-day moving average line. And follow me on this. I'm going to teach our viewers something here. And this comes from about 17 years of experience. The chart itself, whenever the moving average line is in a positive slope for more than 3 weeks at a point, if there's any dip in price below that positive sloping moving average line, it's usually a dip to buy. That will rebound 80 to 90% of the time. I know that sounds like an incredible statistic. I've been following this moving average line across many markets. Because we've had such a price topping action in the last couple of weeks, the average line, only for a couple of days, so there's not a lot of data points, has now moved neutral. There's no slope. So any little bit of bearish news tomorrow, they could absolutely hammer the market, because right now the market is 50-50 up at this level. It's not a bullish crowd. It's even bears to bulls up in this region.
All right, next trade, excellent, interesting. I love those kind of things. Next trade is retailers. They're within the discretionary sector, and they're really leading this market here today. Less worse than expected sales for August is how I see it, and the reality is that expectations were too pessimistic. Analysts once again got it wrong. They were wrong down, and they're going to be wrong all the way back. I'm going to start with the stock man and talk to Gene Profit on this one. Do you like retailers here, Gene, or do you just think that this is just, you know, people having fun and making a quick trade?
Well, I think with today's numbers, I've just gotten a little bit more positive on the retailer names. But it's only the value retailers. Consumers are buying the value proposition here. And names like Costco, Gap, where you're getting a lot for your money, are going to do very much better.
The disaster du jour is a value name, Family Dollar.
Well, again, absolutely. You know, a name like Neiman Marcus is not going to do well today. You see that showing up in the numbers. And with a weak economy, Costco basically would do very well. And like you said, Family Dollar. So I'm not surprised that they're so good today.
John, do you like the retailers here? Do you think that this is just make the money, you know, make hay while the sun is shining, and then watch out in the back half when the unemployment rate fails to go down?
Well, Matt, we all know we've got a very late Labor Day holiday this year, so that's moved the back-to-school shopping back rather than up. and I think that we could see a surprise out of September because of that. Certainly these stronger numbers from Costco doing the same revenue numbers year over year, that's a surprise, and that's why the stock had such a significant pop. Consumers continue to spend, and I think that's something that we can hang our hat on going forward.
All right, let's hang our hats on the price of gold here today. It's going to be, what do you call it, or G1K. There we go, I spit it out right. $1,000 gold, we may hit it again for the 5th or 6th time just this year alone. Do you believe it? What is it telling us about the markets? Does it bode poorly for the stock market, Jimmy Oreo?
No, I don't think it has to at all. And I think it's not completely this global risk aversion trade that people think it is. I think it's a diversification of wealth that's coming out of Asia. There's stories coming out of China that they were going to limit exports of some rare metals, and at the same time a story breaks about them perhaps buying a little more gold. Japan is talking about not buying as much of our long-end treasury debt. I think some of these countries are seriously considering moving their sovereign wealth funds into something other than the U.S. dollar, and each year it's ticked lower and lower, the percentage they've had in dollars. This is bad for the U.S. dollar, but it's fairly good for the stock market. And that the last 6 months, the stock market's rallied based on a weak dollar, the reflation trade. You know, I think that the government was throwing all these dollars at it in hopes of reflating the real estate markets, but the equity markets have been an offshoot of that too. And I don't think it's a bad thing for the equity markets.
And Matt, I'll add this on gold. Technically, we have been in a range near the 950 area, 970 area for 3 months. This is a real breakout here, so I think gold will probably test the 1,017 area.
And another thing too, you have to be long the miners, you have to be long gold, and kind of hope to lose on that trade, because if the big dollar plunge comes, you want to be positioned well to not get cleaned out. So we've seen some call buying in Barrick Gold, things like that. To me, that seems like it's got to be.
I'm just going to say JP Morgan left $8.50 an ounce on the table for 2010. Time for Trading the Globe. The Shanghai posting its biggest gain in 6 months, sending metal stocks higher. This on the heels of Alcoa raising its metal demand outlook for China as well. For more, let's bring in the ambassador himself, Tim Seymour, on the fast line.
Hey, Matt, you're holding the fort down nicely.
Thanks, buddy. What do you think about this?
Well, look, I mean, China demand is up 4%. Klaus Kleinfeld, CEO of Alcoa, had been very conservative. This is a bullish call, but aluminum demand still down 5.5%. What it means, though, is the companies like Alcoa or Rio Tinto, who have the highest leverage, they also have the highest operating leverage in a higher aluminum price environment. So it's given metals names around the world definitely a boost today on a day when actually the CRB is down. I think you get a little bit more of this move, but I don't think there's a lot here. And the tone that these guys are taking on the desk is the one I would believe in, is that we have to be cautious here. Companies like Alcoa have had a big run. I love that chart long term, but I think here you look a little challenged. They go after a Rio Tinto here. I think there's more upside in the short term.
All right, Tim, thanks very much. Appreciate it. On tonight, just for the record, the Fast Money traders are going off the record with Charlie Gasparino about compensation at the rating agencies. They're on the pressure today. The stocks are getting slammed. But up next, move over, Goldman. There's a new power player on Wall Street. Power Lunch opens the doors to the world of a firm that is responsible for